For our presentation, we chose to talk about regulations implemented on nonprofits, especially after the Enron scandal in 2001. These restrictions have required nonprofits to work closely with government agencies and to be more open with the public on their financial reportings. The three main regulations that we discussed in class are an increase in charitable fundraising, advocacy, and nonprofit management practices. Enron is a for-profit organization that focused on American energy. Kenneth Lay was the founder and the CEO of Enron for roughly 20 years. It was founded in Omaha, Nebraska, but relocated to Houston, Texas. It started with a merger of Houston Natural Gas and InterNorth. Lay helped to sell electricity at market prices, and Congress approved legislation deregulating the sale of natural gas. The markets made it possible for companies like Enron to sell energy at higher prices. Energy suppliers like Enron earn profits by providing services in wholesale trading and risk management while also building power plants, pipelines, and storage facilities. They are allowed to report the selling price of product as revenue and the product cost as cost of goods sold due to the risk that they take in incorporating these tasks. They are referred to as an agent that provides services to the customer but does not have the same risks as a merchant. This is where Enron adopted its corrupt accounting techniques by reporting both the product and selling cost as revenue. The scandal was reinforced by COO Jeffrey Skilling developing a staff of executives that used these accounting loopholes, special purpose entities, and poor financial reporting to hide billions of dollars in debt from failed deals and projects. They were using accounting limitations that allowed them to misrepresent earnings and therefore modify the balance sheet. Skilling had the company adopt a market-to-market accounting technique that allowed the company to represent its true economic value. They were the first company to adopt this practice. This type of accounting practice says that once a long-term contract is signed, the income is estimated at the present value of the net cash flow. This made it difficult to estimate the true cost of the company. This practice increased Enron's revenue by 750%. The special purpose entity is a company with an asset liability structure and legal status that makes it secure even if the major company goes bankrupt. It helps protect the project of a company from operational or breakdown issues. It allows them to document its assets, liabilities, and equity on the entity's balance sheet rather than on its own. This gives it lower risks, higher credit ratings, lower funding costs, and lower capital requirement. This means that in order to get the full company's financial situation, you need to look at the company itself and the special purpose entity. In Enron's case, it disclosed very little information on its use of the special purpose entities to the shareholders and to the public. It used upwards of 100 different entities to hide debt from the people. The company disclosed its financial information and conflicts on the balance sheets in the special purpose entity, and not many investors understood how these two worked hand in hand, and is one of the demises of Enron. Enron declared bankruptcy on December 2, 2001. Thousands of people lost their jobs and thousands of investors lost billions of dollars. Enron's stock went from being around $90 a share to roughly $1. The collapse of the seventh largest company in America was not only going to impose implications for business, but for politics and policies as well. The Enron scandal led for the American government to make a major change in policy issues for nonprofit and for-profit businesses. One of the many things that were implemented is the regulation of management. The government enacted the Sarbanes-Oxley Act of 2002, which was a quick response to the accounting fraud committed by both Enron and WorldCom. This was enacted in order to protect investors from the possibility of fraudulent accounting activities by corporations. The act made strict reforms for companies to disclose financial information accurately and to prevent accounting fraud. Section 302 of the act requires senior management to certify the accuracy of the financial report that was given, and Section 404 requires management and auditors to establish internal controls and reporting methods on the accuracy of the control. The Act also has requirements for the information technology areas regarding electronic records. It defines how long and which company records need to be stored on file. This Act made businesses and nonprofits more transparent and more accountable for their actions. The failure in management for Enron and WorldCom led to their demise and created many economic problems for people. Most of the workers at Enron had invested savings or retirement funds into Enron and lost it all when it went under. This act ensures that people do not lose their investments if a company commits accounting fraud. While the Sarbanes-Oxley Act is enacted for for-profit companies, most nonprofits still follow its guidelines. This is because it is known if they are caught doing any of the things mentioned above, they will be held to the same standards as a for-profit company in the eyes of the government. They also know that the government will not stand for an organization dealing with charity committing these types of acts and might be penalized even more.
Another area of government interaction is in the regulation of fundraising. Many states have restrictions on the use of professional fundraisers, commercial co-ventures, securing permits, licenses, or registrations for fundraising activities, and financial reporting. The rule of thumb with donor goods and intentions is that the donors must actually give away funds. They cannot receive goods and services in return for their gifts, nor can they obtain dividends on their investments. Donors can receive recognition and small tokens of appreciation, but if they receive a monetary reward for their donation, they could lose their tax deductions or tax exemption status. The stricter regulations in charitable giving began after the Pension Protection Act of 2006, making donations and gifts harder to give because of the requirements within. The Pension Protection Act was designed to protect donors and the general public, as well as charities, from fraud. The regulations stem from efforts to boost public trust in large companies, whether they are nonprofit or not. Nonprofit organizations have also been under increased regulatory pressures with regard to their policy advocacy activities. An example of this is a law in states that require nonprofit organizations to obtain permission from their members before using membership dues or payroll deductions for anything under the umbrella of political activities, a term that isn't really defined specifically. Another example of this is the Lobbying Disclosure Act of 1995 that imposed restrictions on nonprofits in the political advocacy area. Most seriously, this act prohibits nonprofits that are 501c organizations from engaging in activity if they receive any federal grants, loans, or awards. In conclusion, the Enron scandal had a huge effect on regulations in fundraising, management, and advocacy. This is seen in a quote from Kirk Hansen. This scandal demonstrates the need for significant reforms in accounting and corporate governance in the United States, as well as for a close look at ethical quality of the culture of business generally and of business corporations in the United States.